Hello and welcome grade 12 accounting learners. My name is Mahesh Lal, and today in this accounting lesson we are going to be focusing on certain company concepts. Now let's quickly look at which are the key concepts we're going to be looking at. In this session we will look at transactions affecting the general ledger. Okay, so there we go, our general ledger. Let's just get a pen quickly. All your transactions that will affect the general ledger accounts, and then we're going to move on to the accounting equation. Now before I start talking about companies, what I want to do, grade 12s, is take you a bit back in time. Let's just go back to grade 10. We'll then look at grade 11 and then obviously focus on grade 12. Right, there we go. Now in grade 10, I just want to bring this down a bit. There we go. In grade 10, you were the accountants of a sole trader. Sole meaning there was just one owner. Now because there was just one owner, we taught you that the one owner contributed all the capital to the business. He also, at certain points in time, took money out of the business. So not only capital was contributed, but money being taken out of the business affected drawings. Right, these were the two equity accounts that you came across when you were in grade 10, when you were the accountants of a sole trader. Now, if we moved on, at year end, because there was just one owner who then got all the profits. Exactly, that owner, all the profits belonged to that owner. So when we drew up the profit and loss account, remember that account? Of course you guys do. We recorded all our income on the credit side, all our expenses on the debit side. So let's just use an example. Let's assume our income was 100,000. Our expenses for that financial year, an amount of 80,000. That profit of 20,000 went to the owner. In other words, there was absolutely no sharing. So the profit of 20,000 in grade 10, you closed off to his capital account. Now that was grade 10 accounting. Let's now move on to what happened in grade 11. In grade 11, we trained you to be accountants for partnerships. Okay, what I'm going to do is, let's just change the color of this pen. Right, so we were the accountants of partnerships. That was our form of ownership. Now, remember what you learned about partnerships. There's no more just one owner, but now we've got 2 to 20 partners. The owners were called partners, but we looked at a maximum of 2 owners or 2 partners. So each partner had his own capital account. So you had capital, partner A, and then we had capital that was contributed by, let's assume, partner B. These partners were also entitled to take money out of the business. And because we wanted to keep it separately, we had drawings for partner A. And then we also had drawings for partner B. Then came end of the financial year. Now, unlike your sole trader, when we calculated the profit and loss, we now had to take into account, hang on, we've got 2 partners, so we now need to appropriate. Appropriate meaning we now need to share that profit. So let's just quickly again draw up a profit and loss account. Profit and loss, let's assume again our figures. 100,000 was our income. Our expenses, an amount of 80,000, and yes, we left with a profit of 20,000, but that 20,000 did not go to your capital account, but instead it got transferred. That 20,000 got transferred to a new account called appropriation. Appropriation, like I just explained, meaning that we need to share the profit. So that 20,000 was then shared between partner A, and then we had partner B. Now that was your grade 11 accounting. In grade 12, we now are no longer accountants for just sole traders or partnerships, but we now are the accountants for companies. And more specifically, it's our public company. Now, if we look at a public company, how do they raise capital? You're going to raise capital by selling shares. So you obviously don't just have one owner, but remember, public company, your theory on companies, you must have a minimum of 7 shareholders, and your maximum, there is no maximum, maximum infinity. So you cannot, as accountants, have an infinity number of capital accounts like we did for partnerships. Instead, we now have a consolidated capital account that we call ordinary share capital, which we're going to talk more about later in this lesson. Let's just put that down. Ordinary share capital is our new capital account. So in grade 10 and 11, we call this capital, but now we're just changing the name to ordinary share capital. Now this account, let's just change the color quickly. If we look at this account, it is still going to be owner's equity because the owners are contributing this capital. So you're going to have owner's equity, that's your T account, that's your classification of the account. So our ordinary share capital account classified as owner's equity, because remember, the owners, the shareholders are contributing this capital. So whenever the business sells shares, it's going to affect this account or this equity account called ordinary share capital. Now, apart from ordinary share capital, we are also going to come across an account called share premium, which again is an equity account, owner's equity minus plus. And again, share premium, when we're going to be selling shares, we are going to encounter this T account, this general ledger account. More about that in a moment. Let's just go on. Right, unlike a sole trader and a partnership, we are not going to come across drawings when it comes to companies. So there's no drawings. The owners do not take money out of the business for personal use. Let's now look at what happens at the end of the year end. So we're still going to have our profit and loss account. On the credit side, we're still going to record all our income. So for example, income of 100,000. On the debit side, we're still going to record our expenses. I'm sticking still with the 80,000, which means we now have a profit of 20,000. Now that 20,000, again, like in a partnership, we are going to now close off. Close off meaning we are sending this 20,000 also to an account called appropriation. So to that appropriation account, we're going to transfer the net profit, 20,000. That 20,000, and this is where the changes are now going to occur in terms of what you learned in grade 10 and grade 11. That 20,000, firstly, we need to, let's just put my signs, owner's equity minus plus, that 20,000 needs to be appropriated. Now, the very first person that is entitled to take some of the profits of a company is someone that a lot of us, especially your parents, do not like. Any guesses? That's right, SARS, income tax, the tax man. He's going to take a chunk of that profit. So, for example, from that 20,000, let's assume an amount of 8,000 is going to go towards tax, and we're going to come more, or we're going to look at this account in more detail later on. But for now, let's just call it T for tax. Right, let's now look at what's left over. Left over, we've got 12,000, and you're probably thinking, but hang on, tax or the taxman has taken his share, what about the owners? Yes, the owners will then take a certain chunk of that profit. So from that 20,000, let's now assume an amount of 7,000 goes towards the owners, and the owners' share of profit is what we call dividends, D for dividends. Right, but you're now probably thinking, hang on, 20,000, so tax got 8,000, the owners got dividends, an amount of 7,000. What happens to the amount remaining, the 5,000 that is remaining? Remember, 20,000 minus the 8,000 minus the 7,000 gives me a profit left over of 5,000. Now that 5,000 grade 12s is going to get transferred to an account called retained income. Retained meaning that we're going to keep some of the profits. We're not going to give away everything. Why do we want to retain profits? Why do we want to save? We want to, in order to expand at a later stage, in order for our company to grow. If our company grows, it's going to make more profit, hence the reason for retaining profit, retained income. That's where the balance of that 5,000 Rand is going to go. Right, we've looked at companies in a nutshell. Now let's get into more detail. Let's look at the specific accounts that get affected in terms of companies. Right, the very first transaction that I want to look at in a bit more detail is the selling of shares. Now remember, I've already mentioned that a company raises its capital by selling shares. You're going to come across two concepts when it comes to shares: selling shares at par value, and then we're going to be looking at shares that are sold at a premium. Now let's start with selling shares at par value. The word par, grade 12s, simply refers to the nominal value of shares. Nominal meaning when the company was established, what was that original price that the shares were sold at? What was that par value? What was the nominal value? Now, if we look at shares over a period of time, share prices increase. Yes, share prices decrease as well, but we're going to concentrate on share prices increasing. So when share prices increase, shares are then sold at an amount higher than par value. In other words, shares are sold at a premium. So the concept of premium simply refers to shares being sold higher than its nominal or par value. Right, let's look at an example and let's look at the accounts that will be affected. I'm going to start with the very first example, and I just want to highlight the first example for you. Okay, let's just look at this example. We've got CC Limited sold 100,000 shares at a par value of 2 Rand. Right, let's now look at the accounts that will be affected with this transaction. Now, the very first account is your ordinary share capital account that's going to get affected. If the business has sold shares, and they normally would say or would tell you in the transaction, I'm just giving you a very basic transaction, that the company received and allotted all the shares or received all the money for the shares that were sold. So in that case, it means that my bank account is the second account that gets affected. Now for this 100,000 shares, if I'm selling it at a par value of 2 Rand, I am receiving, or the company is receiving, 100,000 times 2 Rand per share. So the capital that the company is receiving is an amount of 200,000. Right, let's now record this 200,000. So your two accounts, ordinary share capital, owner's equity, and my bank account, let's assume bank is favorable, bank is an asset. Right, let's start with bank. If the business is receiving money, your bank balance has to go up. It has to increase. And the business received 200,000. So bank is obviously the account that gets debited. Let's now look at the account that's going to be credited. If bank is debited, ordinary share capital, the business is receiving capital, so that's obviously very good for the business. So on the credit side, we're going to record our 200,000. Okay, a very, very basic example. Let's now look at the effect something like this or a transaction like this would have on the accounting equation. Remember the equation, A is equal to O plus L. Assets, bank is an asset. Your asset is being debited, therefore your assets are increasing. Money in my bank account is increasing, hence my assets are increasing by the 200,000. At the same time, owner's equity, if we look at O, owner's equity is also increasing by an amount of 200,000. Right, now something that I tell my students all the time. Let's look at this equation, let's look at it mathematically. Is it correct? Now remember, you obviously need to look at the equal to sign. So if I look at the equal to sign, and I'm going to use my hand and I'm going to try and block out the right-hand side of this equation. On the left-hand side, I've got plus 200,000. And now, if I look at the right-hand side of the equation, I've also got my plus 200,000, which means mathematically this equation is correct. Okay, you guys are with me. Right, let's now move on. So we're happy with the concept of par value. Let's now look at shares issued at a premium. Okay, I just want to take out this example quickly. So we have a bit more space. Right, I'm now ready to look at your next example. For our next example, we've got shares are sold at a premium. Example, CC Limited sold 100,000 shares at 2 Rand 50, and then they tell us the par value is 2 Rand. Right, let's now look at how this has changed. So we've got 100,000 shares. It's sold at an amount of 2 Rand 50 cents per share. And now immediately we can see that the shares were sold higher than your par value. Your par value is 2 Rand, but the shares were sold at 2 Rand 50. In other words, at a premium. So immediately I am now going to split this. My 2 Rand is my par value, my premium, an amount of 50 cents. Now how does this affect our ledger accounts? That 2 Rand par value is going to still affect my T account, ordinary share capital. So if we calculate again, we've got 2 Rand, 100,000 shares were sold, so I received capital, or the company received a capital to the amount of 200,000, but in addition to that 200,000, shares were sold at a premium. So that 50 cents is now going to affect my T account called share premium. Share premium, also owner's equity minus plus. If we calculate our premium, 100,000 shares, let's just change that pen color again. We've got 100,000 shares sold at a premium of 50 cents, so times that by 50 cents. So we received an additional 50,000 Rand. We are going to show this 50,000 Rand, like I just explained, into the account called share premium. So share premium, 50,000, owner's equity, and again, can you see? your equity is increasing, this time by an amount of 50,000. Right, if we look at the accounting equation, how this now affects your accounting equation, in total the business obviously received an amount of 250,000. So again, bank gets affected. Bank balance has now increased by that 250,000. So your accounting equation, let's put that up quickly. A is equal to O plus L. Again, my assets are increasing by 250,000. Let's now look at what's happening to equity. Ordinary share capital, owner's equity is increasing by 200,000. And then share premium is also increasing. Another equity account is also increasing by 50,000. So again, mathematically, always check. It takes like 10 seconds to check. On the left-hand side, can you guys see I've got my 250,000, and then on the right-hand side of this equation, I've also got my 250,000. Okay. Right, hopefully everyone understands now the difference between shares sold at par value, shares that are sold at a premium. We're now ready to move on to our next concept of tax, income tax. Right, now remember I explained right at the beginning that a chunk of the profit belongs to SARS. It belongs to the taxman. Now because the company has to pay tax, income tax is an expense for the company. Now remember, general ledger accounts, we always have two accounts that gets affected. So we've got our one account, income tax, which we know now is an expense account. The other account that we're going to come across, the contra account for income tax, is who are we paying this tax to? We are paying it to SARS income tax. So these are the two accounts that affect taxation. Now, before we look at an example, let's look at the concepts that you're going to come across in terms of income tax. Provisional tax is tax payments that are made during the financial year to SARS. SARS is obviously the receiver of revenue. Now, during the year, the company has to make tax payments to the receiver. Then we get our final tax assessment, final meaning at the end of the year, when we calculate our net profit, SARS then determines, or SARS then provides us with a final tax assessment that tells us how much of tax we should be paying for this financial year. So let's just quickly look at the definition of final tax assessment. Tax assessment that is calculated at the end of the financial year. Right, let's move on straight to an example so that we have a clearer understanding of these concepts, provisional tax and your final tax assessment. Right, our example reads as follows. The transactions below relates to CC Limited. On the 31st of August 2010, a payment of 33,000 Rand was made to SARS. Then our next transaction, on the 28th of February 2011, the final tax assessment was calculated at 53,000. So immediately, the very first transaction, on the 31st of August, a payment of 33,000 Rand was made to SARS. This is what we refer to as our provisional tax payment. And then at the end of the year, 28th of February, we received a final tax assessment. This is obviously our final tax assessment, as the transaction says. Right, let's now look at these transactions and let's look at the ledger accounts that will be affected. Okay, I'm going to draw two T accounts because obviously two accounts get affected in terms of a transaction. The first transaction. On the 31st of August 2010, a payment of 33,000 Rand was made to SARS. So immediately, one account that's going to get affected, if I'm making a payment, money is going to come out of my bank account, my as in the company's bank account. Who are we making this payment to? We're making this payment to SARS. So my second account will be SARS income tax. Bank, let's assume bank is an asset, plus minus. SARS income tax, always assume at the beginning, SARS is a liability, minus plus. Right, let's start with our bank account. You are making a payment, or the company is making a payment of 33,000. So what has to happen to your bank balance? If I'm making a payment, money is leaving my bank account. So bank is going to decrease by 33,000. If bank is being credited, the account debited then has to be SARS income tax. So SARS income tax, 33,000 on the debit side. In other words, my liability is decreasing by this amount of 33,000. Now you're probably thinking, but hang on, I don't know how much I'm owing SARS. Okay, I don't have an amount that I'm owing SARS, yet I am making a payment towards SARS. Now, it often happens, and the example that I'm going to use is something that you can relate to, or your parents can relate to. Sometimes we may not know how much we are owing on our electricity account. So, for example, your dad goes to Pick n Pay and decides, since I'm at Pick n Pay, let me pay 500 Rand towards my electricity account. So your dad has no idea, okay, electricity, how much he is owing on that electricity account, how much he is owing Eskom. Your dad has no idea, but he is going to make a payment of 500 Rand towards whatever he is owing. Now the same applies to SARS, obviously a little bit more differently, but the same example. If we look at the same kind of explanation for electricity, we apply the same thing to tax in terms of this provisional payment that is made to the receiver. I have no idea at this point in time how much I'm owing the receiver of revenue, but I'm making a provisional payment of 33,000, which reduces my liability. Okay, you guys got that? Brilliant. Let's now look at the effect this transaction would have on your accounting equation. So your accounting equation, let's just change that pen. A is equal to O plus L. Again, bank is an asset. My asset is decreasing by 33,000. Let's now look at SARS income tax. SARS is a liability, and my liability is also decreasing by 33,000. Okay, you guys got that? Brilliant. Let's move on. Let's now look at your next transaction. On the 28th of Feb 2011, the final tax assessment was calculated an amount of 53,000. Right, there we go. Now we know how much we should pay SARS, what our expense should be. Our expense is 53,000. So immediately, that 53,000, that was the amount that we should pay SARS. That is the amount we consider to be our expense to the receiver of revenue. So the two accounts that will be affected, and I just want to quickly take some of this out. Okay, let's just quickly get the bank out because we're going to get a bit confused if the bank stays. Let's get our accounting equation out of the way. Let's get Eskom out of the way as well. Right, back to the transaction. So that 53,000, we now know what we should pay SARS, an amount of 53,000. So that question mark now falls away. And we're now going to credit SARS income tax with 53,000. if we are crediting SARS income tax, we now can debit an expense account because we know what our expense is, 53,000. So we're going to debit the expense account called, that's right, income tax. Okay, it's simple, absolutely simple. During the year, I make provisional payments to the receiver, and at the end of the year, I now know what my actual tax expense is for the year. Right, let's look at SARS income tax. Let's look at this T account. I am owing the receiver 53,000. I have paid the receiver 33,000, which means if I balance this account, I am now, or I am still owing the receiver a remaining 20,000. Okay, got it. Brilliant. We're going to come across this, or we're going to look at this in more detail when we look at our exam type questions. Right, I want to move on now to the next concept in terms of companies, and this is now the concept of dividends. Again, taking you back to my explanation right at the beginning, we calculated our profit. A certain part of the profit is gone to SARS, the taxman. Now, what about the owners? What about giving them dividends, a share of the profit? So the concept of dividends, you guys are going to come across interim dividend as well as final dividends. Let's start by looking at interim. Interim dividends refers to dividends that are paid during the financial year, whereas final is recommended, and you'll find, or you're going to see, especially when we do exam type questions, that final is never paid. It's normally recommended at the end of the financial year. So if I had to draw a timeline, okay, let's use the financial year 1st March 2010, 28th Feb 2011. Interim dividend is paid during the year, whereas your final dividend is only recommended at the end of your financial year. Right, let's go on straight to a very simple example where we can explain further, or we can elaborate on interim and final dividends. The company issued 100,000 shares. Company declared and paid an interim dividend of 10 cents per share. Company declared a final dividend of 20 cents per share. Okay, so we've got a company that has issued 100,000 shares, and then they go on to tell us the very next transaction. The company declared and paid an interim dividend of 10 cents per share, interim. Let's just make a bit of notes, meaning during the year. And then you've got the company declared a final dividend. This is obviously at the end of the year. Let's start by looking at your interim dividend. For your interim dividend, again, ledger accounts always affects two accounts. Company declared paid interim dividend of 10 cents per share. So the information at the top, the company issued 100,000 shares. So if we have to calculate your interim dividend, number of shares, 100,000. Each share receives 10 cents of the profit. So you've declared and paid an interim dividend of, if we take our 100,000 times 10 cents, we are getting an amount of 10,000 Rand. Right, that 10,000 Rand, let's look at the two accounts that will be affected. One account, the word paid, clearly tells you money is coming out of my bank account. So one account is bank. The second account is, you've got interim dividend, and that's going to affect an expense account called ordinary share dividends. Right, so those are our two accounts that gets affected. Let's now record this 10,000 Rand. Let's start with bank, because bank is always very, very easy to understand. The company again is making a payment, which means your bank balance has to decrease. The company's bank balance is decreasing by the 10,000 Rand. So the account credit will be your bank account. If bank is being credited, ordinary share dividends, which is an equity account, gets debited with your 10,000 Rand. Because remember, ordinary share dividends is an expense. Expenses decrease profit. Let's look at the effect this has on your accounting equation, and you guys should be getting the hang of this by now. A is equal to O plus L. Again, assets, this time decreasing by 10,000. And then we've got owner's equity. Remember, ordinary share dividend is an expense. And expenses, what does expenses do to profit that goes to the owner? It decreases your profit. So owner's equity, let's just put our minus sign here. Owner's equity is decreasing, so minus 10,000. Let's now look at our next transaction. Company declared a final dividend of 20 cents per share. So let's look at the calculation first. Again, company issued 100,000 shares. So you've got 100,000 times 20 cents per share. So the final dividend that was declared was a total of 20,000. Again, 2 ledger accounts will be affected. Right, but now comes the change. The company declared as in, they've obviously held a meeting and they decided to give their shareholders a final dividend of 20 cents per share. Now, declared and paid, there's obviously a clear difference between the two. Declared, I am promising my shareholders, or we've decided to pay the shareholders an amount of 20,000. But have we paid it as yet? No, we haven't, because they haven't used the word and paid. In other words, this hasn't happened as yet. So immediately we can't use our bank account because money has not come out of our bank account as yet. So the account that will get affected instead of bank will be a liability. Liability because we are still owing our shareholders, and that account will be called shareholders for, I'm just going to take this one out, shareholders for, just make this a bit bigger, for dividends. Okay, liability account, shareholders for dividends, because we haven't paid our shareholders as yet. The next account that will be affected again is an expense account called ordinary share dividends. Right, let's look at how we're going to again now record this 20,000 Rand. Shareholders for dividend is a liability, liability minus plus. I am owing, hence my liabilities are increasing, or the company's liabilities will be increasing by this 20,000. So account that gets credited will be your shareholders for dividends. Ordinary shareholders for dividends is owner's equity minus plus, because again it's an expense. On the debit side, 20,000. Okay, right, you guys are with me on this one. Let's now again look at the effect it has on the accounting equation. Asset, we've got no assets. Okay, we've got a liability, we've got owner's equity. So assets, there's no effect on assets. Let's now look at owner's equity. Ordinary share dividends, expense, expenses decrease profits. So owner's equity is decreasing by 20,000. Let's now look at the impact shareholders for dividends being creditors had on liabilities. Your liability is increasing. In other words, I am owing 20,000. Okay, so that's the effect on your accounting equation. Now remember I said always try and check your accounting equation. So let's just check this very, very quickly. If I look at the left-hand side of my equation, in other words, let's just change the color. Okay, if I look at this side or the left-hand side of my equation, assets is equal to 0. If I now look at the right-hand side of my equation, owner's equity minus 20,000, liabilities plus 20,000, it obviously cancels each other out, which means O plus L is also 0, which means mathematically my equation is correct. Right, so as we can see, grade 12s, our equation is mathematically correct. On the left-hand side, we've got 0, and then if we look at O plus L, we also getting 0. Right, grade 12s, we've now come to the end of company concepts, or the key concepts that I wanted to explain. We're now going to take a very short break, and when we return, we're going to reinforce these concepts by doing some exam type questions. Welcome back, grade 12s. Let's now look at an exam type question where we're obviously practicing those ledger accounts that I previously discussed. Right, let's look at our question. Read the information below and complete the ledger accounts. On the answer sheet provided, all accounts must be closed off or balanced. Remember what you guys learned in grade 10. Your nominal accounts must get closed off. Your balance sheet accounts must be properly balanced on the 28th of Feb 2011. And then, very, very important, show bracket work where necessary. Now remember guys, in your final exam, if you're going to show working out or calculations in brackets, it means that even if your final mark or your final amount is incorrect, you are still going to be able to earn some part marks. Right, let's look at the accounts that we're going to be completing. And if I go to the answer sheet, you're going to have to complete your ordinary share cap account. Okay, let's just move back to that. Ordinary share capital account. Let's identify the account quickly. Owner's equity minus plus. Then we need to complete share premium again. Classify the account. Owner's equity minus plus. Then we've got retained income. Also another equity account. SARS income tax, I've already filled in. Liability. Then we've got ordinary share dividends, which we know is owner's equity, and we know it is an expense account. Then we've got our appropriation account, which is the final account that we're going to be completing. Now remember, I didn't discuss appropriation account in detail, but this is where we're going to look at this account, how to complete an appropriation account when we're completing this example. Right, now let's just go back to our question. Okay, I just want to go back a bit. There we go. Let's go back to our question. The information. Sharon Limited, so you're the accountants for a company called Sharon Limited, was founded on the 1st of March 2007 with an authorized share capital of 2 million rand. Now the word authorized, I know you've come across this before, but let's just quickly recap. Authorized simply means in their memorandum of association and the articles of association, what is the maximum number of shares this company is allowed to sell. So you've got an authorized share capital of 200,000 rand, which comprises of 500,000 shares worth 4 rand each. So in other words, your maximum share capital that can be raised, 500,000 times my 4 rand to give me that 2 million rand capital. On this day, in other words, on the 1st of March 2007, the company issued half of its authorized share capital to the public at a selling price of 4 Rand 20 cents. So immediately, if the company has issued half of its authorized shares, remember the maximum shares the company can issue is 500,000. Half of the 500,000 would give me 250,000. 500,000 divided by 2, 250,000 was the shares that were issued at a selling price of 4 Rand 20. Now immediately, guys, remember we discussed par value, we discussed premium. Your par value is 4 Rand, but the company sold shares at 4 Rand 20. In other words, above par value at a premium. So if we had to split this, 4 Rand is my par value, my 20 cents is my share premium. And then they go on to tell us the company's financial year ends on the last day of February. So very, very quickly, because I want to get some kind of indication in terms of the time frame that I'm working on the 1st of March. Okay, if we go back to what is required, 1st of March to the 28th of Feb, year ends 2012, which means the year obviously started 2011. Now remember, this is the beginning of my financial year, and this is obviously the end of my financial year, and I've got to complete 6 ledger accounts for this time frame, 1st of March 2011 to the end of Feb 2012. Right, let's move on to, or let's look at our information, the rest of our information. You've got additional information on the 1st of March 2011, in other words, at the beginning of the year, the following balances appeared in the company's books. So we've got ordinary share capital, a question mark, so they're not giving us the amount. Share premium, also a question mark. We've got a balance for SARS income tax, a credit balance, meaning that SARS is obviously a liability. We are owing SARS. The company is owing the receiver 2,800 Rand from the previous year. We've got shareholders for dividends, 18,000, another liability. The company is owing shareholders 18,000 from the previous year. And then we've got retained income, an amount of 201,990 Rand. Now remember, guys, I spoke about this right at the beginning of the concepts, when I was explaining the concepts. Retained income is profits that the company is obviously retaining or saving. In other words, profits that were not appropriated. Unappropriated profits. Another word for retained income is accumulated profits. Profits that have added up over a period of time. Right, so if we look at our opening balances, because that is the starting point for your general ledger, let's start by calculating our ordinary share capital. Right, so my ordinary share capital, my information at the top, let's go back to that information at the top or at the beginning of the question. You've got 1st of March 2007, company was founded. On this day, the company issued half of its authorized share capital, which means the company issued 250,000 shares at 4 Rand 20. I just want to put that info at the bottom here. So let's just record that. So we've got 250,000 shares, which were issued at a selling price of 4 Rand 20. Now, immediately we know that 4 Rand 20 needs to be split. 4 Rand is my par value, and that 4 Rand par value is going to affect my T account, ordinary share capital. The 20 cents is my premium, and that affects the general ledger account share premium. So if we had to look at our calculation, ordinary share capital, I have issued 250,000 shares at 4 Rand each. So my ordinary share capital, 250,000 times your 4 Rand. Let's just take out our calculators quickly. So we've got 250,000. Oh, too many zeros there. Let's just delete one. Times 4 Rand. So we've got a share capital of 1 million Rand. So we've got, this amount is obviously, just go back there, an amount of 1 million. So immediately, that question mark, my opening balance, an amount of 1 million. Let's now look at share premium, opening balance. So share premium, again, you've issued 250,000 shares at a premium of 20 cents. So your calculation, we are taking 250,000 times your 20 cents. And again, let's go back to our calculators. Okay, we've got 250,000 shares times 20 cents, and we've got an opening balance of 50,000. So that opening balance, just go back there, an amount of 50,000. So again, that question mark we've just calculated, there's my opening balance. Right, now that we have all these amounts, let's now bring down these opening balances. Ordinary share capital, 1 million Rand. So if we go to your ledger account, on the 1st of March 2011, balance brought down 1 million Rand. And remember, the question said show bracket work. So above the word balance, because remember they give you quite a bit of space in terms of the individual lines, we took 250,000 shares, times that by 4 Rand, and that is how we got our million Rand. Let's go to our next account, share premium. Again, beginning of the year, 1st March 2011, balance brought down the 50,000. You guys remember how we got that 50,000? Right, we took the 250,000, we times it by 20 cents, and that is how we got the 50,000. Okay, opening balances for share premium, ordinary share capital. Let's go back to the information. Right, so we've brought down these opening balances. Let's now look at SARS income tax, 2,800. So if we go to our ledger account, SARS income tax, okay, SARS is a liability, 1st March 2011, balance brought down 2,800 Rand on the credit side. Remember, it tells you, the question tells you, SARS has a credit balance. Okay, next opening balance, so we've looked at SARS. Let's now look at shareholders for dividend, 18,000. Now, if we go to our answer booklet or our answer sheet, you're going to find that we don't have a T account for shareholders for dividend. So that is just some additional information that they are giving us. Okay, so this opening balance, we're not going to bring this down. Okay, shareholders for dividends, we are not bringing down that 18,000. And then finally, retained income. This is how much of profits the company has accumulated. Let's bring down that opening balance. Retained income, owner's equity. Profits always good for the business. So on the credit side, this amount of 201,990 Rand, balance brought down again at the beginning of the year. Right, so we've brought down our opening balances. Let's now move on to the rest of the information, where we obviously now going to come across our transactions for the year. In other words, what happened during the year, how these accounts, these 6 accounts, will get affected. On the 18th of March 2011, the company issued checks. So immediately issued checks means there is a payment taking place, and whenever you think of payment, you think of your bank account. Issued checks to shareholders in respect of the dividends owed to them. Now remember, in the previous information, or the opening balances, we owed our shareholders 18,000. What this transaction is simply telling us, we've now paid our shareholders the 18,000. Now, because we don't have to complete shareholders for dividends, when we went through our answer booklets, let's just go back there quickly. Right, if we look at our answer booklet, we don't have an account for shareholders for dividend. Yes, we do have ordinary share dividends, but that's the expense account. We are now looking at the liability shareholders for dividends, which the question obviously does not want us to complete. So again, if we go back to the question, that 18,000 that was owing has now been paid, and we simply leave it for now. We don't record that transaction. Right, if we move on to the next transaction, still on the 18th of March, on the same day, a check was issued to the receiver in respect of tax owed to them. In other words, again, the amount that we were owing SARS, in other words, that opening balance. Let's go to that T account. There we go. The T account, so we were owing SARS 2,800. On the 18th of March, we now paid the receiver. So let's record this transaction. Immediately, your liability, because I'm making a payment, my liability has to decrease. It has to go down. I am paying the receiver 2,800, so on the debit side, I'm going to record the amount 2,800. Because it's a payment, it would come from my CPJ, so that would be my journal or my folio reference. The contra account would be your bank account. Money is obviously coming out of bank, so bank is the other or the contra account, and this is happening on the 18th of March 2011. Right, immediately after we record this transaction, can you guys see that we are not owing the receiver anything? We were owing them 2,800 from last year. We now paid them 2,800. So if you look at this account, we are not owing the receiver any money at this point in time. Right, which is always a good place to be in. Not owe the receiver any money. Okay, let's go back to your question. So we've done with the first transaction, so let's just tick it off. Let's now move on. Your next transaction, a check for 65,000 Rand was sent to SARS on the 1st of September 2011 as a provisional payment. Now remember guys, we spoke about this earlier on. During the course of the year, we have no idea what that final assessment is, but we are paying towards that final assessment. In other words, we are paying a provisional tax or a provisional payment of 65,000. So let's record this in your answer sheet. So SARS income tax, I have no idea what I am owing the receiver. Okay, so I'm just going to put a question mark there. I don't know what I'm owing the receiver because it's obviously not year end, but I do know I'm making a provisional payment. Let's just go back to that amount. Where's that amount? 65,000. So I'm making a payment of 65,000. So again, your liability is going to decrease with this payment of 65,000. Again, journal affected would be your cash payments journal. So that's your folio reference. Contra account, because you're making a payment, it would obviously be your bank account. And the date, this payment was made on the 1st of September. Okay, so back to your answer sheet. 1st of September 2011. Okay, right, happy with that transaction. So let's tick it off because we've obviously now completed this transaction. Let's look at your next transaction. On the 30th of September 2011, the company paid. Again, they're using the word paid. So again, your bank account is obviously affected. An interim dividend of 30 cents per share. Again, guys, we spoke about this concept, interim during the financial year. So 30th of September, remember, that's obviously during the course of the year. The company decided, okay, I think we've got enough profits. Let's make our shareholders happy. Let's pay them an interim dividend of 30 cents per share. Right, let's look at the calculation first before we actually record this transaction. So your calculation will be as follows. Okay, I just want to go to my answer sheet. Okay, ordinary share dividends. Let's just provide some space. Okay, there we go. Right, so your interim dividend. Okay, interim dividend and your calculation. Let's go back to the information. Right, now remember, guys, at the beginning of the year, the company issued, because that's what we need, the company issued 250,000 shares. Just trying to find this information quickly. Right, we spoke about this. The company issued at the beginning of the year 250,000 shares. So let's now look at how much of interim dividend the company is going to end up paying. Okay, so there we go. We've got an interim dividend, number of shares, 250,000 shares. That was your shares issued at the beginning of the year. Each share or each shareholder is going to receive an interim dividend of, back to that transaction. There we go, interim dividend of 30 cents. Okay, right, so times that by 30 cents. Let's take out our calculators so we can calculate this. So we've got an amount of 250,000 shares times each share receives an interim dividend of 30 cents, which gives us an amount of 75,000 that was paid out to our shareholders. So the amount, 35,000. Right, let's now record this 35,000. So it's going to affect your account ordinary share dividends, because remember, it's an expense for the business. So on the debit side, we're going to record our 75,000. If you look at the information that I've already filled in, it would have been recorded in the cash payments journal. So that is your folio reference. Your contra account, because they tell you you paid your shareholders, your contra account will be bank. This is happening on the 30th of September 2011. Now again, guys, bracket work, absolutely important. How did we get the 75,000? We took 250,000 times 30 cents, and that is how we got our 75,000. So even if we make a mistake, and it often happens in the exam where instead of writing 75,000, you write down 7,500. In other words, I leave out 10. As long as I'm showing working out in brackets, I can at least get some part marks. Okay, you guys are with me. Right, let's move on to your next transaction. Okay, so this transaction is obviously completed. On the 1st of January 2012, a second provisional payment of 55,000 Rand was made to the receiver of revenue. So again, we are making a provisional payment of tax to SARS, to the tax man. So let's go back to our ledger account, and it's going to obviously affect, that's right, SARS income tax account. I still have no idea how much I am owing SARS, but I am now making a second provisional payment, an amount of 55,000. So again, on the debit side, because this payment reduces whatever I owe the receiver in the end, CPJ would be my folio reference, bank is my contra account, and the date, this is happening on the 1st of Jan 2012. Okay, so 1st of Jan 2012. Okay, right, easy marks, guys, easy marks. Let's now go back to the question. Okay, next transaction. On the 1st of Jan, let's just bring this down a bit. On the 1st of January 2012, the board of directors decided to issue a further 20,000 shares at 6 Rand per share. So the company or the board decided they obviously need capital, so let's now issue more shares. That is one form of raising capital. So they're going to now issue 20,000 shares at 6 Rand per share. All applications and full payment was received on the 25th of January 2012. Now remember, guys, that date is important, not the 1st of Jan, because on the 25th of January is when all the shares were actually sold to your shareholders. Let's now look at how we're going to record this transaction. Now remember, 20,000 shares issued at 6 Rand. But what was our par value? Our par value, let's go back to the beginning of the question. Your par value, right at the beginning, they mentioned the par value was 4 Rand. So let's go back to the transaction. Okay, so par value is 4 Rand. Shares were sold at 6 Rand. In other words, shares were sold at a premium higher than par value. So your calculation, we've got 20,000 shares, which were sold at or a share price or a selling price of 6 Rand. Immediately, I need to split this. Par value is 4 Rand, which means above par value, my premium is an amount of 2 Rand. 4 Rand will affect your T account, ordinary share capital. The 2 Rand affects your T account share premium. So let's now go to those T accounts and let's now complete the entry in terms of this transaction. So your T account, ordinary share capital account, that's what I want to look at first. Ordinary share capital, just bring this down a bit. Right, so just very quickly, I just want to put the information on this page so that we know exactly how we're calculating this amount. 20,000 shares were issued at a selling price of 6 Rand. On the previous page, we split this into 4 Rand, and we made a split again. The remaining 2 Rand, which is your premium. The 4 Rand affects your T account ordinary share capital. So let's now look at the amount in terms of how much was received, how much we're going to be crediting our ordinary share capital with. 4 Rand times 20,000 shares. 4 Rand times your 20,000 shares. And that gives us an amount of 80,000. Okay, there we go. Right, so 80,000. That 80,000 ordinary share capital, my capital is increasing. So on the credit side, your amount of 80, let's make that a 80,000. Okay. This would have been recorded in your CRJ, so that is your folio reference. That 80,000, the contra account would be bank. Money goes into your bank account, and this is happening on, now I made a mistake, not on the 1st of Jan 2012, because if we go back to the question, all monies were received, shares were allotted on the 31st of Jan. Okay, so if we go back to the question, let's just double check. There we go. Sorry, not the 31st. It was, in fact, the 25th of January 2012. Okay, so let's just change that. That should be the 25th of January 2012 when you received your ordinary share capital. Right, one transaction or one part of the transaction is completed. Let's now look at the next part of the transaction. In other words, the 2 Rand. Now remember, guys, the 2 Rand affects share premium. Your share premium account, in terms of your calculation, 20,000 shares were issued at a premium of 2 Rand, which means we received, or the company received, a share premium of 40,000 Rand, 2 times the 20,000. So let's now record this. There we go, share premium. We've received a share premium of, and I've filled it in for you guys already, an amount of 40,000 Rand. CRJ, contra account again is your bank, and again guys, I made a mistake. This should be the 25th of Jan 2012. Right, again, bracket work, absolutely important, absolutely critical. Bank, above bank, because I've got a bit of space, I'm going to show my calculations in brackets. How did I get that 40,000? I took 20,000 shares times the share premium, which was 2 Rand, and that is how I got my 40,000. Okay, you guys are happy with that? Right, let's move on. Next transaction. Okay, so we're now done with the 1st of Jan. Let's now move on. 28th of Feb 2012. 28th of Feb. Now immediately guys, this is end of the financial year. The profit and loss account showed a net profit of 650,000. So after taking into account all your expenses, all your income, in other words, after drawing up your final account, profit and loss, you are ending up with a profit of 650,000. Now remember guys, that 650,000 now needs to be appropriated. Appropriated meaning it's got to be shared. Who does it have to be shared between? SARS is going to take a chunk of that. Your shareholders will then receive a chunk of it as well, and the balance gets retained. So let's start by transferring the 650,000 into an account called appropriation, so we can appropriate accordingly. So that's 650,000. If I go to my T account appropriation, okay, there we go, appropriation, owner's equity. On the credit side, I'm obviously going to show all my profits. On the debit side, I'm going to show my appropriation, in other words, my expenses. All right, let's start with your profit. You've got a net profit, 650,000. This would be transferred by means of a general journal entry, and remember, it's coming from the T account called profit and loss account. Okay, guys are with me. Right, let's move on. Okay, we're coming now to the end of the question. Last few transactions for us to look at. We've got income tax as per assessment amount to 130,000. Now remember guys, end of the year, you're now getting your income tax assessment, and as per this assessment, the amount of tax you should pay the receiver for this financial year is this amount of 130,000. So we now know what that tax expense for the year is. Let's now record this expense. So the accounts that will be affected for this 130,000 will be my T account, and I just want to show you guys very quickly. Okay, let's look at the T account. It's going to be SARS income tax that's going to get affected, and the other account would be my expense account called income tax. Okay, let's now record this 130,000. Let's find our accounts. Okay, there we go. SARS income tax. So that question mark, now that it obviously falls away because we now know what our expense is. So let's just take that out. Our tax expense for the year is this amount of, let's just go back to the amount because I can't remember the amount. There we go, 130,000. Okay, so your tax assessment, 130,000. Again, you would make a general journal entry to transfer this 130,000 into SARS income tax. The contra account will be the expense account income tax. Okay, and the date is the end of the financial year, 28th of Feb 2012. Okay, guys are with me. Now, why am I not showing the contra account? That's because the question is not asking for the contra account. But remember, guys, income tax would have been the contra account. Income tax is your expense. On the debit side, I would have recorded my 130,000. Okay, happy with that tax assessment. Right, let's move on to the very last transaction before we start closing off or balancing accounts. The company declared a final dividend of 30 cents per share. Right, let's just remove this information very quickly, because this is where we're going to have to do some type of calculation before we do the actual general ledger. Let's read this one more time. The company declared a final dividend. Now remember the word final dividend. I explained the difference between interim and final earlier on, of 30 cents per share. Now before we calculate how much was actually declared to your shareholders, I want to reconstruct the timeline that I drew earlier on. This financial year started on the 1st of March 2011. It ended on the 28th of Feb 2012. Now, at the beginning of the year, do you guys remember how many shares were issued? Okay, let's just quickly go back. At the beginning of the year, if we go to our T account, ordinary share capital, at the beginning of the year, we had issued 250,000 shares. That was the number of shares that were issued. So let's go back to our question. 1st of March 2011, okay, at the beginning of the year, we issued 250,000 shares. Then we had information on the 1st of January, the company decided to issue an additional 20,000 shares. So if we go back to our timeline, let's just plot 1st of Jan. On this timeline, the company now issued an additional 20,000 shares, which means at the end of the financial year, if I had to ask you guys, how many shares has this company now issued in total? Beginning of the year was 250,000. They then issued a further 20,000 shares, which means at the end of the year, the total number of shares that were issued is an amount of 270,000. Okay, you guys are with me. Right, brilliant. So once we've done this calculation for the 270,000, we can now calculate what was that final dividend. So 270,000 shares times your final dividend was 30 cents per share. So times that by 30 cents. Let's take out our calculators. Okay, so we've got 270,000 shares. Each share receives 30 cents. So our final dividend is an amount of 81,000. Okay, so final dividend, 81,000. Okay, there we go. Very, very important calculation. We can't work on the 250,000 shares because at the end of the year, we've obviously issued 270,000 shares. So your journal entry or your general ledger account rather that would be affected with this 81,000 Rand would be as follows. Two accounts, firstly the expense, ordinary share dividends, and then because it's only been declared and not paid, shareholders for dividends. Okay, right, remember guys, we only have ordinary share dividends in our answer sheets. We don't have shareholders for dividends, so we're obviously going to ignore the second T account. So ordinary share dividends, let's go to that account. There we go. No, that's ordinary share capital. Okay, let's find ordinary share dividends. There we go. Our amount, 81,000. So let's fill that in, 81,000. Okay, and again, I want to show a bit of calculation for this 81,000. So because I don't have any space here, I'm going to use the next line. I took 270,000 times 30 cents, and that is how I got my final dividend, 81,000. Okay. Right, we're almost done with these ledger accounts. Let's now go to closing off balancing accounts. I'm going to start first with balancing these accounts. Let's just find the page quickly. There we go. Right, because we've now completed all our transactions. So we've got our first account, ordinary share capital. It's a balance sheet account. I need to balance this account. So very quickly, okay, I've got 1,080,000. Okay. On the debit side, right, you guys know how to balance. This is easy. You've been learning balancing from grade 8, grade 9, grade 10. Okay, so I've got 1,080,000. That becomes my balance carried down at the end of the year, 28th of Feb, 2012, which means on the 1st of March, next financial year, 2012, I will start the financial year with a balance brought down 1,080,000. Okay, let's now go on to the next account. Share premium. Guys, the exact same procedure applies. I've got a balance now of 50,000, was my balance at the beginning of the year, plus my 40,000. So I now have a balance of 90,000. And again, balance carried down 90,000. Okay, which means on the 1st of March, okay guys, I know the handwriting doesn't look very good, but you know how to do this, okay? Balance, that should be better, brought down 90,000. Okay, second account completed. Right, let's look at our next account, retained income. Now this account, guys, is going to be slightly different. We're not going to balance this account, but instead we're now going to transfer this retained income to our appropriation account. Remember, appropriation, we're bringing together all our profits, we're putting it into one place, and then we are appropriating from that profit. Appropriating meaning we are sharing. SARS will get a certain portion of that profit. The shareholders will receive dividends from a certain portion of that profit, and then whatever is left over ends up coming back to retained income. But for now, let's just transfer retained income to appropriation. And remember, this happens at the end of the year, so I'm transferring this amount. In other words, I am sending this account to appropriation. So on the debit side, 201,990. By means of a general journal entry, I am sending it to appropriation. So that is my contra account. This is happening on the 28th of Feb, 2012, at the end of the financial year. Guys, I'm abbreviating, I can do this, but you guys can't. You've got to spell, you've got to write appropriation in full. Okay, so let's go to that appropriation account. There we go. It's profits, retained income. So on the credit side, there's that amount that we are appropriating, sorry, not appropriating, but we are transferring, 201,990. Okay, general journal, and this, remember, came from an account called retained income. Okay, 28th of Feb, 2012. Right, next account. Okay, retained income, we're going to come back to this account right at the end. SARS income tax. Now, if we look at this account, obviously, we now need to balance this account. We're going to ignore the 2,800 because this obviously cancels each other off. If we now look at income tax, 130,000 is what we should pay the receiver. Let's now look at what we've paid the receiver. 65,000 plus the 55,000. So if we calculate that, we've got 65,000 plus 55,000. We've paid the receiver 120,000, which means we still owing the receiver 10,000 Rand. In other words, the receiver of revenue, SARS income tax, is going to end up having a credit balance. We are still owing the receiver. So let's balance this account. You've got an amount of 130,000 on the credit side. On the debit side, let's just fix this quickly. Let's just leave a line there. Okay, so on the credit side, we've got 130,000. On the debit side, we also must end up with 130,000 minus 55,000 minus 65,000. That gives me that balance that I'm still owing the receiver of 10,000. And this becomes my balance carried down on the 28th of Feb 2012. Balance carried down, I can't leave it like that. Balance carried down needs to now get transferred to the credit side. So on the 1st of March 2012, I now have a balance brought down 10,000. In other words, we are still owing the receiver this amount of 10,000 Rand. Okay. Right, guys, we're almost done. Let's now look at our next two accounts. That's all we've got left. Ordinary share dividends is owner's equity. In other words, it's an expense account. All expense account, gets closed off to profit and loss account. However, ordinary share dividends is one of those special expense accounts that gets closed off to an account called appropriation. It gets closed off to your appropriation account. So I've got 75,000 plus my 81,000. So I am closing off an amount of, 006, and then I've got 156,000. Okay, let's now close this off. Closing off, in other words, I am sending this total to appropriation. So on the 28th of Feb 2012, I'm making a transfer to appropriation. General Journal, 156,000. Okay, and this account here will then close off. Let's go to appropriation. Okay, there we go, appropriation. So there's our very first expense account that we closed off. We closed off an amount of, what was it, guys? Let's just go back there. It was an amount of 156,000. General Journal, and remember this amount came from the account ordinary share dividends. Okay, right, what's left for us to now complete or to close off? Appropriation. If you look, we've obviously transferred 156,000, not transferred, but we've given our shareholders their dividends. Remember, we also had taxation that needs to come into this account. So your taxation, we didn't draw up the T account, but income tax is your expense account, and your income tax for the year, if we go back to your transaction very, very quickly, the transactions for tax, there we go, the income tax amount was 130,000. There's that amount. Okay, and remember, we didn't have that T account called income tax, but let's now send this account to appropriation. So income tax, you've got this amount of 130,000. Right, all that's left for us to do now is to look at appropriation. Is there any profits left over? In other words, are there any retained income, or is there any retained income? So if we go to our calculator, our profit, 650,000. Then we had profits from previous years plus 201.99 and a 0. Okay, so that was our total profits. Let's just write that down. Okay, I need the calculator again. 851,990. So we've got that amount of 851,990. Back to your calculator. Right, minus your shareholders received 156,000, minus income tax was an amount of 130,000, and we do have profits left over, an amount of 565,990. So that is our remaining profit. So let's record that. We've got remaining profits of 565,990. In other words, this is the leftover profits that gets transferred back to retained income. Okay, right, this account almost done. Credit side total to the debit side 851,990. Okay, there's my retained profits that I now need to send back to the account retained income. So if we go back to retained income, there we go. We now have on the 28th of Feb 2012 coming from appropriation account. Okay, we've got this amount of 565,990. Right, guys, remember, try and complete as many past papers as you can, because the more practice you get, the better it is for your exam preparations. Right, from me, good luck and hope to see you soon. Thanks, guys.